When the Federal Reserve cuts interest rates, it influences almost every aspect of the economy. Lower borrowing costs, higher consumer spending, and changes in investment trends can significantly impact businesses and individuals. While rate cuts are often used to stimulate economic growth, they also come with potential risks and long-term consequences. Here are 10 major impacts of the Federal Reserve's interest rate cuts on the U.S. economy in 2025. 1. Lower borrowing costs for businesses and consumers. One of the most immediate effects of a rate cut is a decrease in borrowing costs. Businesses can access cheaper loans to expand operations, invest in equipment, or hire more workers. Similarly, consumers benefit from lower mortgage rates, auto loans, and credit card interest rates, making large purchases more affordable. 2. Boost in stock market performance. Lower interest rates make borrowing cheaper for corporations, often leading to higher profits and rising stock prices. Investors also move their money away from low-yield savings accounts and bonds into the stock market in search of higher returns. This increased demand can drive the S&P 500, NASDAQ, and Dow Jones to new highs. 3. Increased consumer spending. As borrowing becomes cheaper, people feel more confident about spending. Lower credit card rates, reduced mortgage payments, and cheaper auto loans leave more money in consumers' pockets, leading to higher spending on goods and services. This surge in consumer demand can help fuel economic growth. 4. Decrease in savings and fixed income earnings. While lower interest rates benefit borrowers, they hurt savers. People who rely on fixed income investments like savings accounts, CDs, and bonds see reduced returns. This particularly affects retirees and conservative investors who depend on these earnings for financial security. 5. Higher inflation risk. Rate cuts stimulate spending and borrowing, which can lead to an increase in demand for goods and services. If the economy overheats, businesses may struggle to keep up with demand, causing prices to rise. Inflation erodes purchasing power, making everyday goods and services more expensive over time. 6. Rising home prices and real estate demand. Lower mortgage rates often lead to a surge in home buying, driving up housing demand and prices. While this is good for homeowners and real estate investors, it can make housing less affordable for first-time buyers. Additionally, lower interest rates encourage real estate developers to take on new projects, increasing housing supply. 7. Weaker U.S. dollar value. When interest rates drop, U.S. Treasury bonds become less attractive to foreign investors, leading to a decline in the value of the U.S. dollar. A weaker dollar makes U.S. exports more competitive in global markets, but it also makes imported goods more expensive, which can contribute to inflation. 8. Higher corporate debt levels. With lower interest rates, businesses often take on more debt to fund expansions, mergers, and acquisitions. While this can boost short-term growth, excessive borrowing can create financial instability, especially if interest rates rise again in the future. High corporate debt increases financial risks during economic downturns. 9. Stimulus for small businesses and startups. Small businesses and startups benefit from lower borrowing costs, making it easier to access capital for growth. Entrepreneurs can secure low-interest business loans, and venture capital firms become more willing to invest in new companies due to the cheaper cost of money. This leads to job creation and innovation. 10. Potential for asset bubbles. When money is cheap, investors pour money into stocks, real estate, and speculative assets. This can lead to artificial price inflation and market bubbles. If rates rise later or economic conditions shift, these bubbles can burst, causing major financial losses. The Federal Reserve's interest rate decisions have far-reaching effects across the economy. While lower rates boost economic activity, they also bring risks like inflation, rising debt, and asset bubbles. Understanding these impacts helps businesses and individuals make informed financial decisions in response to changing economic conditions.